Our guest plays Canadian fixed income all day, every day. He says that sure, economic growth is slowing. Debt levels, both public and private, have been rising. Nevertheless, he sees opportunities in Canadian bonds. Konstantin Boehmer joins us now, head of fixed income and portfolio manager at Mackenzie Investments. Konstantin, always great to see you. Thank you very much indeed.
Likewise.
Of course, bond investors take a different view of economic growth. Sometimes slow economic growth is good for bond prices.
That's right. Yes. So, that is behind my broadly more bullish view on Canadian fixed income, because I do think that the Canadian economy is struggling, unfortunately. The headwinds that we're facing are significant, and those are from housing. I see Toronto, Vancouver more as the epicenters that will maybe radiate outwards to other parts of the country, as opposed to those being completely independent markets. So housing market is in trouble. We have immigration, as we probably all know, having slowed down significantly. That is a meaningful contributor to growth that has broken away. So the job market is somewhat soft. So you have a bunch of headwinds that the economy is facing. Mm-hmm. And that is all okay if you don't have a lot of debt to carry, but the Canadian households are carrying a significant amount of debt, and that is creating an environment which is somewhat complicated.
So longer term, you're positive on Canadian bonds, but you do have concerns in the near term then?
Well, I would say long term, I'm super bullish on Canada as a country, because there is an incredible amount of potential that the country has. But in the short term, maybe also medium term, I am somewhat concerned. I hope there's going to be a slew of positive news coming from pipelines that are being built and refocusing on the natural resource sector, also with the government support. But short to medium term, I'm somewhat concerned because of growth slowing down quite meaningfully while debt levels being really high. And that is, in my opinion, bringing the Bank of Canada also back into play as a support mechanism that is trying to help the economy to get back on its feet.
So do you think the Bank of Canada will cut in the near term again?
Yeah, so we have nothing priced. So if I look at the implied futures, there is nothing that the market is expecting. And I also don't expect them to cut rates here at the next meeting, and probably not even at the January meeting. But once we get into March and beyond, I'm at this stage, with the information that I have, I'm pretty confident that we'll get future rate cuts. And that's not priced in, which creates an opportunity to make money in fixed income, because fixed income would in general benefit quite a bit if the Bank of Canada were to come back to cut rates. But again, it is not imminent. It is not at the next meeting, probably not at the one after. But coming back in March, I would not be surprised to see 50 to 100 basis points of cuts coming from Bank of Canada.
Oh, that's interesting. But I think, reflecting your strategy there, you would favor short-term Canadian bonds then, in the near term anyway.
That's right. So that would be anything 2-year, 3-year, maybe 5, also 10 is probably going to be okay. 30 years, it becomes a different story, because the long end of the curve doesn't really trade much based on how much the central bank is cutting rates. Here, you're talking a lot more about debt sustainability and those kind of issues. And those can become a hot spot. We've seen it in the UK, we've seen it in Japan, where at some point you cannot just borrow more money. There is a pay for, and that pay for is either at the long end of the bond curve or through the currency markets.
What is your thought on Japan? We've seen that big backup in Japanese long-term bond yields, the government apparently wanting to spend its way out of slow growth.
Yeah, that is the fixed income market that has been painful for anyone who has been invested in Japan. I'm probably at this stage where I'm becoming more interested in owning Japanese bonds, because the country has to make a decision of whether to support the bond market or to support the currency markets. And given how weak the Japanese yen is, and given how undervalued the Japanese yen is relative to all the other countries, it is hard to imagine that seeing the yen weaken any further is a long-term strategy that will be successful. As such, Bank of Japan is probably being forced to hike rates. So that is different to Canada, different to probably also the United States. So they will have to raise interest rates in order to make sure that the currency is not selling off by too much. So that would bring the front end of the yield curve higher, but would provide some form of stabilization maybe in other parts of the yield curve.
And it's interesting looking at emerging markets. You say some countries, including Brazil, Mexico, and South Africa, are doing a pretty good job of managing their debt loads.
Yeah, I mean, nothing in absolute terms. It's also not looking fantastic there, but it is. If I compare that to what is happening in developed markets, the gap between emerging markets and developed markets seems to be closing. So it is, developed markets are getting worse faster. So on a relative basis, some of those emerging markets are starting to look quite a bit better, and you get compensated for it, right? So their yield levels are in many cases substantially higher. You're talking about high single-digit yields for 10-year bonds, low double digits, so anywhere like 9 to 12% or so yields for a investment which looks, I would say, reasonable. It does carry some risk. So if there's a major bump in the road in risky assets, so if equities were to take, for example, a 10, 20% dip, of course, those emerging markets would also fall in value. But overall, I think that is a risk that I like and that we're taking in our funds.
And just broadly, Konstantin, what about U.S. bonds, say the 10-year bond in the States? Is that attracting you at all right now?
I would say somewhat boring. There's over the year, there were moments where it was really interesting, really attractive. Right now, we have 100 basis points of interest rate cuts being priced for the next year. Yeah, seems reasonable, seems fair. There are some lingering concerns about the bifurcation of the U.S. economy, where you have some parts doing exceptionally well and other parts not doing well at all. And the central bank is probably looking at the areas of the economy that are not doing so well in order to dictate how their policy rate will adjust. Therefore, we're seeing 100 basis points of cuts, and I think we're getting a good amount of those in the next few meetings.
Konstantin, thank you very much. Konstantin Boehmer, Head of Fixed Income and Portfolio Manager at Mackenzie Investments.